We hope this snow didn't scare off too many people, but it may have, but it's not going to do much. And that's supposed to be in at 12. But you all are probably like elementary and high school, like late schedule, you like a snow day. Education is one product you don't like to get your money's worth. You'd like to miss, or you'd like to have a snow day or a late schedule, whatever. But anyhow, hopefully you get your money's worth. Amber is live streaming, Walter Brown's here today. Both Alexander's here today, Sage is here. Ellen made it, Alta made it, Margot made it, Robert Harris. I don't see Robert. Dylan, don't see Dylan either. Another one made it. Kendrick is here. Tyler didn't make it today. Jessica's here. Kelly's here. Morgan has not made it today. Eva is here. Carson's here. Carlos is here. McKinley, Williams is here. Jacob is here. Chris is here. Franco is here. Okay. All right, we need to get started. I want you to turn your books to chapter 11. I want you to go to problem 3. That will be on page 973. I got, whoa, I was looking at it at a distance, 573. All right. I had AV to install a little gizmo here, and that's what this little gizmo is. It's like an Elmo. Sometimes you don't have a book, and I have you working on exercise, and I guess this thing has I call it a gizmo, but it's actually some kind of overhead projector. But this problem, it's in Cengage, and it's also one that I recommend you work with book. I don't know, they may be identical, I don't know. We'll need to look at it and see if you're having any trouble with it. But anyway, this company started business, salaries were paid to employees on the last day of a month. Social Security, Medicare, federal income tax were withheld. An employee who is hired in the middle of the month receives half the salary. All required payroll reports were filed, and the correct amount of payroll taxes was remitted for the whole year. Early in 20,000, whatever, 19, I guess, before the wage and tax statements, W-2s could be prepared for distribution and for filing with the Social Security Administration. The employees' records were inadvertently destroyed. None of the employees resigned or were discharged during the year, and there was no change in salaries. The Social Security tax rate is 6%, Medicare 1.5%. Data on the dates of employment, salary rates, and employment income taxes withheld were summarized as follows: were obtained from personnel records and other payroll records. All right, we have these employees, we have the month they were hired, we have their monthly salary, we have their monthly income tax withheld. All right, now calculate the amount to be reported on each employee's wage and tax statement. All right, arranging the data in the following form. All right. Now on the first employee up there, all right, calculate the following employer's payroll tax for the year: Social Security, Medicare. That's all we need right now for this part. Okay, now, if Arnett was hired in November the 16th, he got a half a month's salary for November, right? He got a whole month's salary for December. So what is 5,500 and then half of 5,500? Kelly, do you have that part?
It had like this huge chart, like with those headings on it.
Right.
I didn't have it.
You had a huge chart in Cengage
Yeah.
with those headings. All right, but well, keep your book turned to this page and I'll show you how this is calculated. But the monthly income tax was $944. He was hired in November the 16th, so it'd only be a half a month of tax. Now that huge chart, you probably had some other lines there for Social Security and FUTA and SUTA. Now, when it gets down here, it says federal unemployment comp at 6% on the first 10,000 of each employee's earnings. Now, in the real world, that's about 7,000. But they're using a rounding number 10. Now, this employee never made 10,000. So we'll take 10% of his totals. 5.4 and 0.6 of his total salary. Now, this employee, January made 4,800. February made 4,800. That's 9,600. Now, in March, we'd only tax 400 for FUTA and SUTA. That brings it up to 10,000. And then you quit withholding any more FUTA and SUTA. You don't withhold it. The employer pays it. All right. Now, I don't think we have to go to any chart since they gave us the income tax. Okay, I can't show you everything here at once, so let me show you. All right, they got a month and a half of salary, a month and a half of federal income tax, and then you multiply 8,250 by your Social Security tax rate of 6%, and then you multiply that amount times 1.5 for Medicare. Is that the chart you had in similar? Okay. Now the whole 8,250 you'd have to pay. They don't have any more of a chart. That's problem 4. So you can put that like problem 4 in a payroll register, but computers makes that a lot easier. Computers makes all this easier. All right. So what we would do here for FUT and SUTA would take that whole amount, 10,000, 10,000, that whole amount, 10,000, 10,000, that whole amount, add them up and multiply by your 5.4 for state and 0.6 for federal. All right, Social Security tax on the employer is the same as on the employees, and so is Medicare. Now, this one, it's got an underline, red line under it. He made 116,000. The gross earnings are determined. No, that didn't help it, did it? There's a limit. What did your book say the limit was on Social Security? Probably 110 or something, because this one paid the full amount of Social Security. All right. How much?
I don't see that.
Well, I can easily have you to figure here. Take the Social Security tax on this person, divide 9,660, divide that by 6.5. Somebody divide this by decimal, 0.65. 6960. I'm thinking that may give you 110,000. Check it out though. What'd you get, say?
Supposed to do 107,000.
107? Maybe the cutoff rate was 107. Well, let's try the one above there then. Try 6,600 by 6.5. That give you 107,000 also? Something's wrong. It should be the
I
same.
don't think there's any limit.
The what?
I don't think there was any limit on them.
But you have to have a limit to be able to find the taxes. In other words, how would you find these if you didn't know the limit?
They just gave us a rate. Oh, do you mean where it says for the first 10,000?
No, that's clear. It's the first 10,000 for FUTA and SUTA. That's clear. Medicare is clear, 1.5% on everything they make. That's clear. Social Security does have a limit. And right here,
Not on ours, not on the problem. There's no social security limit.
no limit.
No.
Well, then multiply this then times 6.5. Multiply this times 6.5. Did you get 6960? Then there's a limit. William, would you do something, do this with for me? Multiply 57.6 times 6.5. Jessica?
Yeah.
Multiply 110 times 6.5. Say, multiply 116 times 6.5.
Our social security is 6%.
Yeah,
Oh, is it 6?
it's 6. I was wondering why you were saying 6.
Because the real rate is 6.5 in the real world, that's why 6. All right, so divide 116,000 by decimal zero,
I get the 6960.
divide 6960 by decimal 06.
116,000.
Okay, then there is no limit. In the real world, there's a limit though over here on Social Security. In the real world, it's 6.5, not 6. So that's all they're doing is taking 6% times the gross amount and 1.5 times the gross amount. All right. Now get down to number 2.8 on this problem. Calculate the employer's payroll tax, Social Security. Well, Social Security tax is the same thing that you see here on the employee. It's the same thing on the employer. Now, Medicare tax is the same thing on the employer as it is on the employee. So those two are no problem. But now you get down to C part, this is what I was telling you. Earnings subject to unemployment comp, 10,000 for all employees except Arnett, Arvin, and Ward. Just take their amounts, they're under 10. Add them all up, you get 6208 subject to SUTA. And you get 62,080 subject to FUTA. All right, and you got your total tax when you add the 1, the 2, the 3, the 4, and you get 28,450. That's why. Kelly, has that helped? You did not have to go to the federal income tax charts in the book. Okay. And you had no limit on Social Security. All right. But I didn't ask you to do number 4. And that's just a payroll register, but you did it manually. Before computers came on the scene, you had to keep payroll manual. You had to keep a payroll register. And to do that, we just did normal earnings, overtime earnings, total earnings, Social Security tax, all right, Medicare tax, federal income tax. You have to look at the charts for that. Retirement, total, subtract that from the gross, get net pay, Then you write out a check, and that was debited to salary expense, some to office expense. All right, and this then became the line to make your journal entries. Debit salary expense 19,060, office salary expense 38, Social Security tax payable 1371, right here, Medicare tax, federal income tax payable. And of course, we should have had a salaries payable here for the difference. All right, any more questions on Cengage? I know, has everybody gotten into Cengage? One person couldn't get into Cengage. It's something about her account, and she will have to call and get it straightened out. Okay? Is everybody else getting into Cengage? Now, who else has finished 100%? Who has finished Cengage 100%?
Chapter 11.
Chapter 11, yeah. That's chapter 11. I see your hand. Carlos, how you doing on Cengage? Author?
That's it.
Have you got part of it finished? All right, I asked you to have that finished by today. All right, Tuesday, you must have it finished because I'm going to record the grades on there Tuesday. No need to do anything after Tuesday. Okay? Now, somebody had trouble getting into Cengage. Okay? I'll wake up, I'll like I'll give you a little more privilege since you're having a hard time getting Cengage. But the rest of you, I'll copy down your grade Tuesday. If you finish at 30%, you got a 30 on that part. There's no need to do anything on chapter 11 after Tuesday. I can't close it, and I won't close it, but I can take the grade you got at that point. Okay. All right. We got to have time limits and deadlines. Now, when you're talking about payroll, if you were doing payroll for this company, I don't care if you're doing it manual or computerized, these 7 employees want a paycheck. And you are pressured to get payroll out on time. All right? Now, a lot of these companies in January, they're pressured to get out your W-2s by January 31st. They can get a stay, I guess, to February 15th. But all these companies have to get out the W-2s by January 31st. And then if you got interest statements from the bank or dividend statements, they got to get those out, I think, by February 15th. So all companies are under pressure to carry through with the payroll responsibilities. Okay, now we must dig into chapter 12 a little more than what we did the other day. But the other day we worked on splitting salary and what have you. Now, the LLC works about like a partnership. Very few entries different. A limited liability company. You can read to learn the objectives. Now, these are the 4 forms of ownership, and the limited liability company is the newest form, and a lot of companies, partnerships are using that. And we know a proprietorship is one person. And here we have lawyers, architects, realtors, physicians. We have a lot of proprietorships, accounting and tax preparing, the repairman, the contractor, whoever. All right, characteristics of a proprietorship, just to run through those again. Easy to form, no limitation on legal liability. You can be sued and they can take everything you have. Proprietorship is not taxable. Only the owner is taxable. It has a limited life. If the owner dies, no more proprietorship. And they can't raise as much capital because they're one person. Then we get over to partnership, 2 or more people. All right. It's not really complex to form. Just do an agreement. And the same characteristics as proprietorship. No limitation on legal liability. Come in, lady. All right. It's not taxable. The owners are taxable, not the partnership. It has a limited life, and it has limited ability to raise capital unless you have 600 partners. A partner, you co-ownership of property. You're mutual agents for that partnership. Participation in income. All right. An LLC is a form of legal entity that provides limited liability to its owners, but is treated as a partnership for tax purposes. But you can do an LLC for one owner also. Characteristics of an LLC. You have limited legal liability, and this is your best characteristic. The owners are still taxable. It has unlimited life because it can be passed on to another person. And same ability to raise capital. And in your book, you have this chart showing you the forms of ownership. All right, now, you students from other countries, Billy, do you still have the 3 forms of ownership, proprietorship, corporation, partnership? Serbia?
I can ask my mom, she owns
If she owns the business, so they must have.
it. But I don't think she has any partners.
Well, she's a partnership then, probably. Eva? We know that Spain has partnerships, corporations, and partnerships. How about Argentina? Yeah. How about France? Yeah. Most countries do. Okay. Unless you have a country that is solely a dictatorship and everything is owned by the government, then you don't have any kind of market system, free enterprise system, and so forth. If it's a total dictatorship. All right, now forming a partnership, this is also mentioned in your book. Now, Joseph and Earl, they have 2 hardware stores, but they want to join and make one hardware store. So Stevens agrees to donate the following items. Now, all you got to do is make an entry in debit cash, and debit accounts receivable, debit inventory, debit equipment, debit more equipment, credit allowance for doubtful accounts, and credit accounts payable. The difference between your credits and debits is capital. So that's all Stevens is doing to start a partnership. And his capital is $56,000. Just remember, allowance for doubtful accounts is a contra asset account. It has a credit balance. All right, but now going back and look at this inventory. The inventory is 28.7. And here we're putting it down 28.7. Now the store equipment is 54. And here they say 54. Now, where do these values come from? Now, the store equipment on Stevens' books might have been 4,000, but this is the fair market value. You start a partnership, it's brand new. Fair market value of the inventory, fair market value of the office equipment, and fair your accounts receivable. You may want to up your allowance for doubtful accounts. You think those can't be collected? So you take the fair market value of assets a partner is putting into the business. What difference do you see on a LLC? There's only one. What is that one difference? Alexander, do you see that?
Sure.
All right, let's go back.
The member equality.
Here's a partnership. What'd you say, Robert?
The member, when it says member equality,
Right. Members' equity
equity.
and here's capital. Capital for partnership. Equity, members' equity for, okay. Only difference. Okay, now Reese Howe here is putting in cash and inventory and equipment, and he has a notes payable, and his capital is 66. That's just under exercise. All right. Now here is income or losses to a partnership, and if you have no agreement, how do you divide income? Equal. Services of a partnership, again, if somebody works 40 hours and somebody else works 30 hours, that's 4 to 3. All right, that's 4/7 and 3/7. Services and investment of the partnership. All right, we're going to divide $150,000 of net income. All right, we're going to give a salary of 60 to Stone, 48. That means 108,000. There's 42 left, and we're dividing that equal. And here's what we would debit, credit their capital account for, and debit income summary. They make 2 closing entries. You do your revenue, and expenses, and capital. Now, LLC would do revenue, expenses, and members' equity. If you take out a drawing, that is your other closing entry. Debit their capital and credit their drawing. They also can take out a drawing. It's just members' equity on an LLC. All right, we got this for the other day. A partner's salary, interest to the partners, and then remaining can be equal. It could be a ratio. Now here, still the 150,000. If we divide that, give them a salary allowance, interest on their investment, and then the remainder looks like equal. And then we have this as net income to those 2 partners. Same type of closing entries. All right, here you have 100,000 net income. So look at this when you have a deficit. You're trying to give 108,000 salary out. You don't have it. But you go through the same format. You're trying to give out interest, but you don't have it. You do not have 141,000. You only have 100. So we minus that difference. We split it and minus it. And we still have to equal 100,000. Same type of closing entry. All right. Here we're forming a partnership. We have salary allowance of 42, interest of 9, any remaining equal. Prince and Bernard had 20 and 50 in their capital account. Net income was 240. So take a minute and split that net income. Just do this on plain scrap sheet of paper. Take a minute and work this little exercise. Got an answer, Jessica, for Steve? You have how much capital Steve will get? Kendrick?
I want to say it's 91,350.
91 what now?
91,350.
Well, that may be right, but I don't know what she means by dividing equal. That's what's left.
Yeah.
All right, after you give them a salary of 42, one gets a salary of 42, and they get 9% interest. 9% of 20,000 is what, 1,800? And 9% of 150,000, what is $1,350? All right, you got to subtract that out, and that leaves, looks to me like it'd be more than 91,350, but you may be right. Let's see. I can get to stay where I want it. All right, salary allowance 42,000. Make your chart. Interest of 18 and 13.5. All All right, added together is 57,300. But now I see where you're right. You've got 182,000 to split, don't you? If you divide that by 2, that does give them the remainder of 91,350. So that's where you got to 91,350. All right, it was a good answer, but not to the question. Good answer, wrong question. All right. The question I asked, how much net income does Prince get? He gets 135,150. All right. And Bernard gets 104,850. All right. Let's change this just a little bit. I'm going to leave everything the same. But we're only going to have net income of $50,000. Do this whole chart over again. Use a net income of $50,000.
What about where it says, Bernard's, capital is 150,000?
Everything's the same. Everything's the same. Net income is just 50. Okay. The total of 42 stays the same. The total of 15,3 stays the same. The total of 57,3 stays the same. But we don't have 57,3, we got 50. So you've got a minus 73 here. Now, that has to add up to 50,000. 57,3 minus 73 is 50,000. Now we split that 73 equal. How much is that? Is that 3650? All right, so these amounts is going to be 3650. So how much capital does S. Prince receive? How much?
60,150.
And then how much does C. Bernard receive?
159,850.
How much?
159,850.
Can't be right. These are minuses.
I got 40,150 for Prince, 9,850 for
All right,
40,000.
for 40,000.
Oh, never mind. Sorry.
All right, it's there somewhere. But Jessica, you've only got 43.8 for S. Prince, and we got minus 3650. All right. Now that brings us down to 40,000. I think that's 150, isn't it, Jacob?
Yeah.
All right. And then this person only has 13.5.
I just read it wrong.
Okay.
I had it wrong.
Take
I
out,
did the
that's all right. Take out the 3650. Now there's 40,150 plus 9850. Does that equal 50,000? Yes. 50,000's got to be your answer, vertical and horizontal. That's about as hard as it gets in splitting salaries. Now, we did that the other day. We've done that today, and it's also on Cengage. Now we want to omit a partner. We've got 2 or 3 partners. We're going to omit another partner. Now that partner can donate assets, or he can just purchase interest of other partners. All right. Okay. Now it does not matter if a partner has 50,000, if partner X has 50,000, he's going to sell half of that to partner A. You would debit partner A 25,000. No, you debit partner X capital 25, and you credit partner A 25. It does not matter what one partner pays the other partner. He could have gave him $1 for his 25,000. He could have gave him 100,000. All right, let's submit a partner here. Assume Tom and Nathan, they each sell 1/5 of their equity. All right, they're going to sell that to Joe for 10,000 in cash. Now we're going to have to debit cash 10,000, but we're going to get rid of 1/5 of Nathan's equity and 1/5 of Tom's equity. The partnership has total assets of 120 and total liabilities of 20. Well, that leaves you 100,000 capital, doesn't it? They both have 50,000 apiece. What is 1/5 of 50,000? What is 1/5 of 50,000? All right. And then 1/5 of the other 50,000 is 10,000. So this new partner is going to get 20,000 capital. But he only gives how much? They sell 1/5 of their equity. The Joe Cantor of 10,000. 10,000 in cash. It didn't say inch. So let's see what kind of entry they came up with. All right. You get rid of, they took the cash. That does not affect the partnership. You debit Tom capital, Nathan capital, and credit Joe capital. It does not matter if he gave them 10,000 or 5,000 or $1 or a bag of peanuts. This same entry. Why would you sell him? Now, these guys are only going to get 5,000 cash apiece. Why would you sell $10,000 worth of capital for $5,000? Why would you do that? Do you need another partner that bad? Why do they need this partner? I mean, what does this partner bring to the table? And so forth. If it were an LLC, it'd look the same, except it's members' equity instead of owner's equity or capital. All right. The assets remain the same. But here we have 40,000 capital balance and 40,000 balance and 20,000 together. That is your 100,000 of net assets. The interest would be the same no matter what he paid to those other partners. All right, we're going to let a partner in now. He's going to purchase a fifth. He's just going to put 20,000 cash in the business. He's going to get ownership equity of 20,000. That makes it clean. Debit cash and credit his capital, 20,000. That's all you do. Unless they come up with some other stipulation. Here we have 120,000 assets, 120,000 capital. All right. Now, if we give that partner more equity, sometime we may have to adjust the inventory value. We're going to debit merchandise inventory and credit Tom and Nathan capital. That's the old partner. Now they're splitting equally, 1/2 apiece. So that's 1,500, 1,500. Now it can get tough there. They have equipment, accumulated depreciation. All right. Here, you're going to write that equipment down 5,000. All right, it was on the books for 15, but it's only worth 10. So 4,000 that we can take out of accumulated depreciation. And then Tom and Nathan take a $500 loss apiece. So a lot in this chapter. That's just omitting a part. Now we may have to revalue land. Land was revalued to a market value of 260. We had 200 on the books, so we got 60,000 debit to land. And these partners must have a 1-to-2 ratio, which gives them a 1/3 and 2/3. So one gets 20,000, the other one gets 40 of that land revaluation. So look out for that on Cengage. Now, what this is talking about, folks, we've got partner A. He's going to give $50,000, but he's going to get 60,000 of capital. You're going to give him more capital than the cash he puts in the business. So that extra 10,000 has to come out of the old partner's account. We could reverse that. He has to pay 70,000 to get 50,000 capital in the business. Now, in this situation, we may want him so bad, or we may need his cash. We're willing to give him 50,000, 60,000 for 50,000 investment. Here, we don't need him. He's willing to give us 70 for a 50,000 investment because it's a good, maybe booming business. So pay close attention in omitting a partner and giving him a bonus, or the partner's taking a bonus. All right, here's the capital balances of Marcia and Helen. All right, 20 and 24,000. Now, it looks like they may be taking in Alex. Okay. All right, they agreed to admit Diaz to the partnership for $31,000. In return, he will receive 1/3 equity in the partnership. All right, capital we had before was 20 and 24. He's going to donate 31,000. He's only going to get 1/3 of that equity, which is 25,000. So, but he gave 31. What do we do with the other 6? We give it to the old partners. And they were splitting things equal. So he gives 31, he gets 25. The old partners gain 3 apiece. So he gave a bonus to get into the business. He gave 31 and only got 25. Here's a reverse situation. We've got Janice and Steve. And whatever his name is, Coas, donates 30. He gets 1/4 of the partnership, which is 37.5. He's paying 30 and he's getting 37.5. So the old partners have to give up 7,500 capital. And they did that in a 2-to-1 ratio. One partner gave up 5, one partner gave up 25, and there's your journal entry. So omitting a partner can be complicated. So first off, in this chapter, interest for a partnership, number 1. Second thing for this chapter, dividing income, number 2. Third thing for this chapter is omitting a partner, number 3. There's 2 more categories in this chapter. 1 is letting a partner go, and 2 is liquidation. So there's 5 concepts you've got to get a handle on this chapter.
What was the first 2?
First one was journal entries to form a partnership. The second was splitting net income of a partnership. The third one was omitting a partner, which we just looked at. Now the fourth one is letting the partner go. And the fifth one will be liquidation. So you need to read this chapter well. You need to start working on Cengage. I'll give you some exercises in a few minutes also to work on the help. Okay? All right. So this is called the 4th part, withdrawal of a partner. Okay? Now, if you have trouble with this, or if it's frustrating, let's do what Arthur's doing in the back. Sleep on it. Okay? Okay? Anyhow, withdrawal of a partner. All right. You've got 3 or 4 partners and one wants to go. Maybe one dies, maybe whatever. Now you can sell it to the existing partners or to the partnership. Let's skip this and go on to partner dies, close the accounts, then worry about how to start the partnership back. All right, here, this is liquidation. We'll get back to that other partnership in a minute, withdrawal partner. Anyway, we sell the partnership assets if we want to liquidate. We may have a gain or a loss. So we distribute that gain or loss. Then we pay all the creditors, all the payables first. And hopefully we have the exact amount of cash left to give each partner when we liquidate. All right, now here's a final trial balance of what you've got. All right. Now, if we can sell these non-cash assets for $64,000, everything's hunky-dory. Okay? You can pay your liabilities and give your capital accounts out and close the partnership. If we could debit cash for 64 and credit non-cash assets for 64, that's not likely. You've got store equipment, merchandise inventory, non-cash assets, computers, trucks, whatever. You won't get the identical amount that's on your books. Now they share profit and losses in a 5-3-2. We know that adds up to 10. 5/10 is 50%, 3/10 is 30%, 2/10 is 20%. All non-cash assets are sold in a single transaction for 72. All right, you had a gain of how much? All right, break that gain up real quick. See the paper somewhere. Break that gain of 8,000 up into these percents. About to quit snowing. There's nothing on the roads, nothing in the parking lot, so you're not going to go out there and slip slide away. All right. How about Farley? How much of that gain does he get? 4,000. And how about Green? And how about Hall?
16.
All right, now here is a statement that you need to get familiar with. All right. Well, it decided to disappear on me for a minute. You take your balances. Now, here you're going to debit cash and minus your non-cash. Now, you're going to split that profit here and here and here. Now, here's what you have left at this point in time. You have enough cash to pay your liabilities. And when you pay your liabilities, here's what you have left. We've got enough capital, 74,000 cash, to pay off each person and have zero balances. That's a statement of liquidation. It's pretty easy once you practice a couple. That is the fifth concept in this chapter. I want you to look at this same problem here. But we're going to sell the non-cash assets. We're going to sell them for just 50,000. All right. So I want you to fill in these amounts here. If we sold the asset for 50,000. How much does each partner lose is what I want you to fill in. Okay, so how did we split that $14,000 loss? How much of that does we sold these assets for 50,000? How much of that does Farley lose? All right, Farley, that will be 7,000 for Farley. How much will Green lose? 4,200. And how much will Hall lose? 48, 28. All right. And when you work this thing through, then you will have zero balances. Okay. All right. Let me give you some exercises. Let's see if this IMAX, it's IM, I call it IMAX now. See if it works. All right, page 614. I want you to do exercise 12, 1, 3, 10, 14, 16, 24. If you'll practice those before Tuesday, you'll start getting a handle on this chapter. Then we'll look at problems next Thursday. And please be working with Cengage too, okay? All right, I'm gonna let you go today. Don't worry about the snow. It's quick. It's not slick, okay?